Welcome to the deep dive. Today we're cutting straight through the noise surrounding Freeport's Q3 2025 earnings release.
Yeah, it's a real study in extremes, isn't it? You've got
Yeah.
these strong financial, really strong, thanks to copper prices.
Right.
But then completely opposed, you have this awful operational hit from the mud rush incident in Indonesia. Just terrible.
Absolutely. So our mission today, let's unpack the core results, especially that earnings beat, and then really dig into the forward guidance because that's what tells you where things are actually headed.
Okay.
Let's kick off with the financials then, the resilience they showed in Q3.
Right, the big picture beat. It was pretty surprising to many, I think, given what happened in September. Freeport definitely defied the consensus view.
They certainly did. Adjusted earnings per share came in at $0.50. Now, that's way above the $0.41 expected, like 31% up year over year.
So why was the street so off? Fundamentally, I think the market just underestimated how much insulation they'd get from copper prices being so high.
And the revenue reflected that too.
Exactly. Revenue clocked in at $6.97 billion.
Yeah.
That beat estimates by, what, over $200 million?
And the key driver there, the real lifeline, was that average realized copper price.
Mm-hmm.
It hit $4.68 per pound in Q3. That's up quite a bit from $4.30 a year ago.
And what's fascinating here are the underlying global demand factors.
Mm-hmm.
You've got electrification, you've got the huge build out of data centers, renewable energy infrastructure.
Right. All copper hungry.
All copper hungry.
Yeah.
It's driving this demand, making that price volatility work, heavily in Freeport's favor this time. Honestly, that price strength really shielded the P&L from an operational disaster that could have sunk a company dealing with a lower-priced commodity.
Okay, but hang on. Focusing only on that $1.50 adjusted EPS, isn't that a bit misleading, given that a huge chunk of their operation in Indonesia was offline for part of the quarter?
At the really critical point.
Are investors maybe looking past the real structural risk there?
Yeah, you have to look closer. And that brings us to the net income detail. So Q3 net income attributable to common stock, the GAAP number, was $674 million, or CO.46 per share.
Okay.
The adjusted figure, the 50 cents everyone's quoting, was $722 million. And crucially, that number excludes specific charges primarily tied to the incident costs.
Ah, okay.
So yes, the underlying business profitability powered by copper looked phenomenal. But the true costs of the incident were already there, just sort of lurking off to the side in the adjustments.
Right. Which makes the transition to the Indonesia impact absolutely essential.
Yeah.
We have to talk about the crisis itself.
We do. And before the numbers, just the severity.
Yes.
The incident happened September 8th at the Grasberg Block Cave underground mine. Terribly, 7 fatalities resulted. It was a sudden mud rush. Just, hundreds of thousands of tons of wet material flooding into the mine.
Awful.
Operations were suspended immediately. Priority was recovery, investigation. The human cost is obviously immense, and the financial fallout stems directly from that complete operational stop.
And we can start to quantify that immediate impact, even just within Q3. Consolidated copper sales, 977 million pounds. That was actually 1% lower than their July guidance.
Right, and gold was off even more. Consolidated gold sales hit 336,000 ounces, which was 4% below what they guided in July.
So the suspension, just in Q3, cut copper production by roughly 90 million pounds.
Estimated, yeah. About 90 million pounds of copper and around 80,000 ounces of gold. That volume just vanished from the quarter's output.
Okay, but then here's the number that seems, confusing. When you look at their reported Q3 costs, consolidated unit net cash costs were $1.40 per pound of copper,
Right.
which was better than the $1.59 they guided earlier. How on earth do costs improve when you shut down a massive mine?
Okay, this is probably the single most important accounting detail you need to get from this whole thing. That $1.40 unit cost figure, it's basically an artifact of the accounting.
How so?
It excludes $171 million in costs. Specifically, idle facility costs and recovery expenses that are directly tied to the mud rush incident.
So they're effectively pushing the true cost of the disaster into later periods, or at least separating it out on the income statement, making Q3's cost per pound look, deceptively lean.
Precisely. Standard accounting lets you do that. You categorize those as sort of one-time or unusual expenses. They hit the adjusted net income reconciliation, but they don't get loaded into the operating unit cash cost calculation for the pounds you did produce.
But basic logic says if you stop producing volume from a huge fixed cost asset,
your unit cost should skyrocket. Exactly. But if you don't include the fixed costs associated with the idle volume in that calculation, the remaining volume looks artificially cheap per pound.
Okay, got it. And that setup perfectly explains the whiplash we see coming in the Q4 forecast.
It perfectly foreshadows it because in Q4, that operational reality, the cost reality, it just can't be masked anymore.
All right, let's pivot then. Forward guidance, this is where that cost accounting paradox bites back hard.
Yes, it resolves itself with a massive punch to the Q4 numbers. You see the impact dragging down the full-year outlook first.
Right. Full year consolidated sales now expected around 3.5 billion pounds of copper, 1.05 million ounces of gold. That's definitely below where hopes were earlier in the year.
And the caution around Q4 specifically is, well, it's severe. Fourth quarter copper sales forecasted at only 635 million pounds.
635 million. That's a huge drop.
It is, and that number explicitly assumes minimal contribution from Indonesia while they work on that phased restart.
Okay, so minimal contribution from Grasberg, plus the full weight of those fixed costs hitting a much smaller volume base. That means those previously excluded disaster-related costs are now landing squarely on the operational numbers.
Exactly. And that leads directly to that, frankly, terrifying Q4 unit cost forecast.
What is it?
Well, the full-year average is expected to land around $1.68 per pound, which still sounds okay, maybe.
All right, so four.
But Q4 alone is forecast to jump to a shocking $2.47 per pound.
Wow. $2.47. That's up from $1.47 Q3.
A staggering jump. And that number, the $2.47, that's the cold, hard reality of running a massive high fixed cost operation at incredibly low volume.
It's like running a giant factory at, I don't know, 20% capacity.
Precisely. You might cut some variable costs, sure, but the enormous fixed costs, maintenance, security, minimum staffing, they get spread over far fewer pounds of output. Each pound becomes much, much more expensive to produce.
So that $2.47 really crystallizes the financial pain of the suspension. No hiding it there.
None at all. Yet, despite these huge operational headaches, that underlying copper market strength provides a lot of stability. Operating cash flows are still expected to be around $5.5 billion for the full year 2025.
Okay, that's still pretty robust, assuming copper prices stay strong, maybe around $4.75.
That's the assumption baked in, yeah.
Yeah.
And crucially, look at how they're managing capital expenditures.
Right, they pulled back on CapEx.
They did. Total CapEx now expected around $4.5 billion for 2025. That's down $400 million, $0.4 billion from their prior guidance.
Which shows they're being careful.
It clearly shows they're controlling near-term, maybe more discretionary spending, while the Grasberg situation and ramp-up remain so uncertain. They're prioritizing liquidity, keeping cash handy.
Okay. So that CapEx reduction, it's interesting. They're pausing smaller things, but it sounds like the really big long-term strategic projects are still moving forward.
That's right. And it really highlights how much they rely on their operations outside Indonesia for stability right now.
In North and South America, providing that buffer, over half their production comes from there. Right?
Over 50%, yeah. And we saw that buffer working in Q3. Copper sales from their U.S. mines were actually up 7% year over year, helped offset some of that lost Indonesian volume.
And they're squeezing more efficiency out of those assets, too.
They are, like the autonomous haulage conversion at the Baghdad mine in Arizona that's apparently substantially complete now. They're innovating, optimizing what they solidly control.
Okay, let's look at those big multi-billion-dollar bets then, because this crisis must just accelerate how important they are.
Absolutely. First, there's the leaching technology focus. They're targeting an additional 300 million pounds of copper production annually by 2026, just from new leaching initiatives.
Which is vital for getting more out of lower-grade ores, particularly in the U.S.
Exactly. And then you have the monster organic growth projects. These seem non-negotiable, despite the current Grasberg issues.
Like the Baghdad expansion?
Yeah, the Baghdad expansion in Arizona. Estimated $3.5 billion cost to potentially double the concentrator capacity there. Shows a huge commitment to U.S. stability. Needs a copper price below $4 to make sense long-term, they note, but still.
And the other big one is in Chile.
El Abra, evaluating the sulfide resource there. That has the potential, if developed, to add maybe 750 million pounds of copper annually.
Yeah.
So the takeaway is clear. They are aggressively putting capital towards politically stable, long-lived assets. It's a hedge against Grasberg's inherent volatility, which just became painfully obvious.
It really confirms that structural pivot towards diversification. But let's bring it back to Grasberg's long-term forecast. A phased restart is expected maybe late this year, ramping up in 2026. But the initial damage assessment sounds Pretty brutal.
It is stark. Now, the preliminary estimates they shared suggest a potential 35% reduction in PTFIs. That's their Indonesian subsidiary 2026 copper and gold production compared to what they expected before the incident.
35%. That is a massive chunk of global supply potentially offline for a prolonged period.
It really is. However, it's crucial to note, they are navigating this from a position of considerable financial strength. Their net debt is only $1.7 billion.
Which is well below their target range.
Way below. Their target's $3 to $4 billion. And they're sitting on $4.3 billion in consolidated cash. So they absolutely have the financial firepower to manage this operational downturn, rebuild, and invest.
Okay, and before we wrap up, there's a key date listeners need to mark down.
Yes, absolutely critical. Freeport has scheduled a conference call for November 18, 2025. That's when they plan to provide a detailed report on the investigation findings and, importantly, present their official multi-year operational and financial outlook for Grasberg and the company.
So everything until November 18th is really just informed guesswork based on these Q3 numbers and initial estimate.
Pretty much. That call will be the definitive update.
Okay, so boiling it all down for you listening, what does this really mean? The big takeaway seems to be this incredible contrast. On one hand, you had the power of that commodity price tailwind delivering a really unexpected earnings beat in Q3.
Right, but countered completely by this sudden, severe, and unfortunately long-term operational bottleneck in Indonesia. And the true cost of that is going to fully hit the books in Q4 with that extreme cost spike we talked about.
The company itself is financially healthy, no question. Lots of liquidity, net debt well under control.
Definitely. But the supply side risk from Grasberg, it's very real, and it looks like it persists well into 2026, maybe beyond. This crisis just slams home the importance of their strategic shift towards North and South American assets. Diversification isn't just nice to have, it's paramount now.
So here's the provocative thought to leave you with. You've got this strong underlying global demand for copper, right? Driven by EVs, AI data centers, the grid build-out.
The demand story is strong.
But now you have a confirmed significant long-term supply interruption at one of the world's largest copper mines, Grasberg. So what does that potential 35% reduction in PTFI's estimated 2026 production truly imply? Not just for Freeport, but for future copper prices globally, and maybe even for the cost structure of their competitors.
That's the multi-billion-dollar question hanging over the market.
And we won't really get the full picture until that November 18th update. We've done the deep dive, now you're informed.